are banks dead?
No, banks are not dead, and I don't think banks are going to die in the near future. Banks are always evolving, and they've evolved from the banks that we understood that started off, say, from the type of bank where the bank manager knew all the people at their local branch, the Captain Mannering type of bank manager. That's definitely gone. What we've seen is technology replace many of the functions that banks do. Now, to some extent, that's been to the detriment of some types of customers, particularly small businesses. But by and large, what's been happening is that competition, and we'll get onto this later, but competition from non-banks and from within banks have led banks to close branches, to depend more on technology, to do online banking or telephone banking, basically arm's length banking. And that personal relationship banking that we recognized from decades ago, that has certainly evolved. There's still room for that in banking, but the tendency has moved towards more technology and transactional banking, as we call it, where you use internet, online, and more arm's length type of approach to banking.
Of course. So how did we get here? Can you just briefly give me some sort of history over how banking has evolved over time? I mean, ultimately, I guess you could go back to the Roman period where where we started using coinage and things like that, at least on a mass scale through. But could you just give me a brief history of how we got to this point, and so to give us the semblance of what the banking industry is today?
Well, banking traditionally, and that from going back to the medieval times of the Medicis, has been one of taking money from depositors and making loans to borrowers. Now, banking has evolved really through centuries. Basically, that's been the model. And what we've seen is improvements in the technology of dealing with that. In the past, of course, banks only lent out what they had brought in because it was very much a gold standard. But as we moved away from the gold standard towards a paper currency of what's called fiat money, what's happened is that banks were able to transform maturity because people who put their money in as deposits have a contract to take their money out anytime, all right, on demand. However, banks make contracts with borrowers to lend them out for 2 or 3 years. How does that happen? It's like magic. If you can take your money out at any time, but at the same time, the bank can lend it out for 2 or 3 years, the same money, how can that happen? Well, it happens because, you can think of the stock of money as a bathtub full of water. And you've taken the plug out and there's money coming out because people are withdrawing their money on demand. People are also putting money in because the tap is on and they're repaying loans. As long as the bathtub remains with the same amount of water, okay, that's the stock. You can think of that as the stock of money. They can lend that out. And the way they can do that is because they know that not everybody wants to take their money out at the same time. Of course, if everybody did want to take their money out at the same time, they don't have it. They've lent it out. And that's what happened in the 1930s, in the Great Crash. Everybody tried to take their money out at the same time. They all wanted to go liquid at the same time. Banks didn't have them. Banks had lent them all out. Banks, therefore, were illiquid. At that time, there wasn't that lender of last resort system where the central bank simply prints money and gives it to the banks to say, here, make sure that you can repay your withdrawals. At that time, they didn't have it, and so the banks closed. When the banks closed, of course, we had the crisis of the 1930s. So that's basically the model of banks. And banks still do that. And why they're important is because of that payment system. Banks offer two services. They keep your money safe and they pay you a rate of interest on savings, but at the same time, they allow you to take your money out on time. Now, we need that to buy goods and services. Today, of course, we don't need to go and get money out from the bank. We use our phone or our card. But the principle is the same. It's still electronically transferring funds from the bank back to you. You buy goods with that. That money goes back into the banking system and it circulates inside.
Sure. And there's a lot of stuff in there in terms of how the bank, particularly over the last century or so, from being on a gold standard essentially to the incorporation of fractional reserve banking to sort of the inclusion and decline of the Bretton Woods system. With regards to that system in particular, has the post Bretton Woods era positively impacted banking, or has there been an associated amount of negatives that have come across moving to a system where ultimately money is just is what it worth compared to other currencies across the globe?
Well, the breakup of the Bretton Woods system meant that banks had to manage different types of risk. Before that, it was very much a fixed exchange rate system, and that made life easier for the banks. But of course, the global trade was increasing, and banks were following their customers around the world. But of course, with the breakup of the Bretton Woods system, they had to deal with exchange rate risk. And there was a huge volatility of interest rates because governments began to use monetary policy more actively. They couldn't do that under Bretton Woods because under the fixed exchange rate system, if they expanded their economy using monetary policy, they'd suck in imports, and that would cause an exchange rate crisis. And so they could undertake independent monetary policy. Once governments started to do monetary policy, of course, interest rates began to move because inflation began to move. And so banks then had to deal with different types of risk: interest rate risk, inflation risk, capital risk as values of assets moved up and down. All these things was, of course, banks had to develop and evolve. And that's what they did. Also, world trade was expanding, and there came after Bretton Woods a whole series of deregulations where banks were allowed to do some things that were not allowed to do, and non-bank institutions began to do banking things. The classic one is building societies start to offer banking services, banks started to offer mortgages. And that competition meant that banks had to evolve even more and had to develop different business models. And that's where banks really began to change with deregulation, because the old model of simply taking in money for deposits and making loans had to be superseded with other financial services because there was a lot of competition around. There was a lot of non-bank financial institutions like building societies offering something similar. So banks started to offer financial services, or what they call now off-balance sheet activities, which was to offer insurance services, underwriting services, advice, financial advice, overseas transactions, contingent liabilities, where if you needed a loan but you don't need it right now, you pay a fee for that, and if you need it, you can have it. That kind of thing, all that evolved. So banks began to depend not just on their core business, but also on the other financial services. And so huge competition, from non-banks and other financial institutions, and even retail companies that started to offer banking services.
Sure. There's a couple of angles I think I want to sort of dive off there. I think I'm going to have to choose one and then maybe come back to one in a second. I think because we talked about some of the deregulation coming post Bretton Woods, I think that it's quite pertinent then to start talking about what happened and leading up to the 2008 financial crisis. It's been such an influential event in the world economy. I mean, every single time I do research on economic research for the UK, it's something along the lines of we haven't been able to get back up productivity and real wage growth hasn't necessarily increased since 2008, which is, it's not like a short time ago now. It's a good 15, 20 years ago. And so it was clearly an incredibly influential event and is probably the linchpin in where I think a lot of the UK's problems economically have probably stemmed from. I think to start off with, could you just give me a little bit of an overlay and an outline of like what led up to 2008, and then what caused it, what were the pertinent factors, and then talk to me a little bit about the impact as well.
Okay, in some ways, it was a repeat of history of the 1930s. It was the real estate sector that banks were lending to, and in the 1930s, of course, house prices, when they fell, retail estate fell, that meant that the banks had lent to that, found that they had that assets that had deteriorated. It was similar, but in a slightly different way, because what banks had done was that securitized many of these loans which had made to real estate. And so these securitized, if you understand what I mean, is that what they do
Sure.
is they take these loans and they make them into securities and they sell them off in the
Yeah.
banking
Package them up.
patched them up. Yeah. Now, of course, the way they did that was in the way that they didn't know which of these securitized assets were good and which ones were bad. They were layered in different ways, a bit like the old-fashioned CDs that had samplers, where the first two songs were good ones and the next ones were okay, and then the rest were rubbish. So in that way they couldn't tell what they had. So the banks found that their assets had deteriorated, and they stopped lending. And what's more, they stopped lending to each other. That was the worst thing, because in the 1930s, the banks just collapsed. But now, banks depended through the interbank market to provide liquidity to each other. They stopped lending to each other. The central banks, of course, pumped liquidity into the system through quantitative easing, but the banks still did not lend. What they did was they kept that money as reserves. And of course, some central banks paid interest on those reserves, so they stuffed them in with the central bank because it was safe. What banks realized was that they had underpriced risk leading up to the global financial crisis. And then they realized, oh my God, there's a lot of risk out there. Okay, well, we're not going to do any risk. We're not going to lend to small businesses, which are risky. They're not going to lend to other enterprises. They'd only lend to very safe enterprises who didn't need the money, by the way. So they'd only lend to the government. And so basically, the money wasn't getting out into the economy. And it's argued that that may have contributed to the productivity slowdown, because simply the drivers of productivity are small businesses. This is where the innovation comes from. And certainly, following the global financial crisis, the types of regulation that have come out have really hindered banks in lending. So banks went through a period of, underpricing risk to overpricing risk. And then when they're in the mood to start lending, they found that regulation wasn't going to do it for them either. So to some extent, I think 2008, 2009, that period of the global financial crisis marked a turning point where banks have become overcautious. And with that overcaution came also, following on the heels of that, was regulation. And that simply meant that banks have stopped doing the kind of risk stuff that they did. Now, so they may have taken too much risk in the past, but now they don't take any risks.
Yeah, and this is certainly something I've heard as a potential cause as why productivity hasn't necessarily been able to increase at the rates there was before the financial crisis. And it's just the fact that, the UK is an incredibly reliant on financial services. It's our biggest, trade surplus that we have. Is London is with New York as an alpha plus plus city, it's one of the most influential cities in the world in terms of financial services and these kind of things. It's tough in one regard, because I do hear this narrative about increased regulation, or maybe it's worse regulation. Maybe you can comment a little bit on that. But on the other side of it as well, I think people are obviously just very cautious about the fact that banks can essentially just create money out of air through fractional reserve banking. It's not like, a coffee shop can necessarily do that. And ultimately, because these businesses, these banks, are so intertwined with society that essentially if they do go bust, they basically have to get bought out, which is what happened in 2008. Your local coffee shop doesn't have the same luxury. I think people are generally just quite apprehensive about the abilities for, banks to be able to do these kind of things. But then you have to, like I say, you have to contrast that with this kind of regulation aspect of it. What aspects of the regulation that has come in, maybe through Basel III, kind of post financial crisis, that has led to some of this slowed productivity and slowed growth, you think?
I think essentially it's been this diversion of lending away from the small business sector. We're seeing, by the way, some signs that that's being revived. But essentially, the small business sector continue to complain that the banks are not affording them the kind of credit they had before. And there are two things with it. One is that capital has been, the banks have been expected to increase their capital ratios, and that's made capital expensive. And so banks then require a good return on their equity for their shareholders because they've got more of this capital. Now, um, some argue, of course, well, banks are safer as a result of this capital and they should be able to command a lower capital cost. That's not obviously the case. I mean, what's happened is that shareholders are looking to banks to remunerate them for their capital, and the riskiness of small businesses have meant that banks have shied away from that towards a sector that's been hungry for liquidity. And now that sector actually turns out to be not big business, but government. You know, governments have expanded their sector tremendously since the global financial crisis, and then along came COVID. And it's not just the government in this country, but all over the world, governments have expanded and they've had to borrow. And that borrowing meant that banks have a safe way of adjusting their assets closer towards something that's got a very sure return. Uh, uh, and so the governments have been crowding out the private business. Ironically, the private business that is most affected is not the big businesses because those big businesses don't need banks. They can go to the capital market. And so it's really the medium-sized and small businesses that have been crowded out as a result of this. Now, whether that has affected productivity, I'm not sure. I can't tell, but certainly they are connected. I mean, they're connected in the sense that the growing public sector, which we know has a lower productivity growth than the private sector historically. Um, a banking sector that's overcautious and is taking low risk and not lending towards the small business sector, these must contribute to productivity growth. And of course, we're waiting for technology to tell us, whether this is going to be the driver of productivity. But so far, nothing much. The stock market thinks it is happening, but nothing in the productivity figures to suggest that AI is going to come rushing in and fill the gap.
So you have a table in your book, what I was going through regarding sort of the profitability of banks or the banks in certain countries over certain periods of time. It's sort of outlining the kind of real rate of return and stuff. And the UK seems to do quite well in this table. It's got in and around or above, the other countries, Germany, France, whoever it be. But then you look at the States in that table and it's like double the profitability. And now these profit margins aren't big. We're talking, at least I think the most recent stats you give from like 2017, where it's 0.6% for the UK, and sort of other countries, and then America is about 1.4%. These aren't massive profit margins, but that difference between the UK or just other banking economies and the US seems to be quite stark. Why is it that American banks and institutions are so much more profitable? Or has it changed since 2017? I think it's the last bit of data that I saw on it.
The US banking sector has able to come out of the global financial crisis much faster than the UK and Europe, partly because of the Federal Reserve policy of actually pumping money directly into the banks and allowing them, taking off their worst assets, essentially the government sector underwriting them. We've done that indirectly in Europe and in the UK. What we've done is that we've actually our quantitative easing has been to buy assets from the non-bank financial sector first. from pension funds and stock market, companies, equity companies, and the result has been that we've pumped in liquidity to them with the objective of reversing the downturn in the stock market. That then buttresses asset prices, which is supposed to help with banks. That may have been one of the reasons why US banks came out much faster. Historically, there have been a higher profit margin, and it's difficult to explain why that is. I mean, in the UK, we don't necessarily have huge competition because our banking system is highly concentrated. But what we do have is competition from non-banks and challenger banks. And these challenger banks have eaten away at the traditional sector part of the banking business, which is the business of taking in deposits and making loans, leaving banks to move towards the non-interest part of their business, off-balance sheet stuff. That has maintained their high return on equity, but their return on assets have been declining simply because of the competition. So I think looking at across Europe, there has been a lot of competition that's forced down spreads and margins, forcing them to move towards non-interest activities or non-lending activities and other financial services. And of course, it is suggested that Europe and the EU banking market is a lot more regulated than the US, and that's another possible argument for why the US has been able to maintain a higher profitability.
Hmm. Sure. I mean, certainly from my understanding, the EU is much more regulated. We're slightly less regulated in the EU, but America is the sort of the least regulated, and that might have something to do with the profit margins, I guess. It might also be to honestly the fact that, working out of America, you get to sort of benefit from the reserve currency and other sort of stabilities and educated individuals coming from certain institutions. There could be a myriad of factors, I guess. The growth of fintech has been an interesting one. You have this sort of rise of many different services across financial technology, whether that be social media payments, whether that be sort of online banks. They're really a myriad of different institutions and different developments in technology. What kind of threats does that pose to the traditional banking industry? Is it something that, you know, are these startups able to actually compete with the institutional banks on a level playing field? Are they much more profitable than them? Are the institutional banks ultimately, can they do services and stuff that these other fintech startups just can't do? What kind of threat is the fintech industry posing to the traditional banking system as we know it?
I think the traditional banks are under great threat by fintech. Um, Fintech is able to take away the sort of business that I would call the traditional banking business of taking in deposits and making loans. But fintech can only do it up to a certain amount because fintech deposits don't have deposit insurance. They're not banks. Well, in a way, they're like equity platforms. Fintech can enable you to make investments, and just like a bank, you can put in a small deposit and have lots and lots of these small deposits which are targeted to its particular investments. So the way they work, the fintech platform will offer you various projects, and you can, and they'll give you a risk rating, and so you understand what the risk is. They're using AI to understand these risks, and so you know what you're doing in that sense. Okay, you're going in for a risky project. You can bid for, to have a higher rate of interest, and the platform will consolidate all these bids and then offer the loan to the borrower and say, look, this is what we can match you with. So they're matching those who want to invest with those who want to borrow. And of course, you keep your money in there for the period of the loan, but you can sell it to other partners inside the fintech. So there's a certain element of withdrawal that you have with banks. Problem is that there's a certain amount of capital risk. I mean, the platform might underwrite the capital amount. So if you put £1 in, you can sometimes take £1 out. When you put £1 into a bank, you know you can take £1 out. Okay. You also have deposit insurance with the bank. So that means that the bank can charge for that safety by not having to pay as high a rate of interest as you'd get from fintech. So now let's ask ourselves, what type of person will take their money out of a bank and put it in fintech? It's someone probably more technically savvy, a younger person who's possibly looking for a higher return on their savings, and be able to still withdraw money if they can, by selling their share to other partners on the fintech platform. But the world is aging, and what we know about an aging population is that they become a lot more risk averse, right? And for that reason alone, there's going to be a demand for the traditional banks where people will just put their money into a deposit and know they can take it out, because they know that there's a certainty involved with that. So in that sense, long term, banks will still survive, but yes, they're going to lose market share particularly from younger generation people who will go into fintech, or people who are a bit more riskier and a bit more adventurous and willing to do that. Now, these fintech platforms will, of course, now work in partnership with banks, because what we've been seeing is that banks start to offer similar type of services as fintech, in the sense of using online platforms to be able to service loan applications. What's good about fintech is that if you're going to make a loan application, you do your loan application, and within hours, they say you can get a yes or no. Okay, sometimes even earlier than that, within minutes. Well, banks are using the same kind of technology. They're suggesting, instead of coming to apply for a loan and talking to a person, go online. And in fact, if you go into a bank, they'll just say, go online. Okay, do it all online. And the result is that you can almost get your loan as long as it's small and you've got a certain amount of information about you, which the banks would take as hard information that's verifiable. There's a very high probability that you will get these small loans. Now, banks recognize that these small loans will probably have a higher delinquency because they don't have a person vetting you. It's a machine or a computer that's doing it. And possibly, they may not be as good as a person. Well, they'll take the hit on non-performing loans, but they're saving on not having a relationship manager there. They're closing branches. So they're reducing their operational costs to offset the fact that there might be a higher delinquency on these small loans. Now turn to the borrower. The borrower will want to apply for a small loan, and if they can apply to a fintech platform, yes, and they'll get it. But suppose they want to go for something slightly larger. That fintech platform may not be able to find matching suppliers, funds for that slightly larger loan. They will go into partnership with banks to say, look, we've got some here who our AI system tells us are relatively safe. You might be willing to take those. Now, banks actually have the liquidity to absorb those kind of borrowers. So you can see in some countries, particularly, say, take China, for instance, where banks are in partnership with fintech platforms to be able to work together, where very small loans can go to the fintechs, but slightly larger loans can be passed to the banks. And the banks starting to use the same technology as the fintech platforms to help with their loans as well. So that partnership that will certainly allow banks to absorb some of the losses that are coming from people moving away to fintech. So banks are evolving. It's always what they've always done ever since the Medicis. They have been evolving, and they'll be different. The bank of the future will be different, but they will still be there.
Sure. It would just be a bank that incorporates AI and all this other kind of different technology that we'll use. I mean, you mentioned that there about how some of these fintech platforms are able to use AI to sort of look at and assess candidates for things like loans and stuff. Do you anticipate that AI is going to replace bankers, or is it simply just going to allow bankers to do better, greater work?
I think AI will certainly replace bankers for small loans because the, these will certainly be less costly and faster.
Hmm.
Now, the higher delinquency rate means that banks could use these small loans as a screening mechanism to distinguish between good borrowers, good quality borrowers, and bad quality borrowers. In the sense that if you are unable to meet your loan payments on FinTech or online platforms, you're actually revealing that you're high risk. So you're not going to get any higher loans, larger loans, or any repeat loans. Okay, so in a way, AI actually acts as screening because once you've defaulted on a loan on an online platform or a fintech platform, that information is picked up by the AI systems, and you get a bad reputation. So that's one thing that AI will do. It will replace bankers. Now, suppose, of course, you might say, well, people can game the system. A high risk borrower can pretend to be a good risk by repaying their loans on the fintech platform or the digital platform on a bank with the anticipation of applying for a larger loan. And that when they get that larger loan, they become riskier. Well, then, of course, that's where banks come back in. They'll need a relationship manager. So if I'm applying for, say, a small business for a loan of £50,000, I'm very likely to get it. And if I'm a high risk borrower, I pretend I'm a low risk by repaying and uh, being a good customer. I then signal to the bank that I'm a good customer. I now want 250,000 or 500,000. Um, well, it's a high risk. The bank will say you've been a good customer so far, but now you deserve an actual person, a relationship manager who will look at your business plan, look at you as a person, look at you in the eye and decide, are you a good risk or not? And that's traditional banking. So in a way, what banks have done is used AI to move from one step onto a second stage. They might use AI even in the second stage, in which case real people will be at the third stage. But at some point, banking is a personal business
Hmm.
because you're dealing with people, and the way that a bank can decide on the riskiness, part of it is not just the business plan and the product, but the person who's running it. And
Hmm.
so they'll have to come and see you and say, develop a relationship.
No, certainly. Sounds like we're not going to get rid of them just yet, by the sounds of it. AI is not going to take over the whole industry, at least maybe in my lifetime anyway.
Will be a
Uh,
smaller banking system, and that's something that I've always emphasized to my students of banking. That you're joining a declining industry in terms of employment, but of course, those who do go into banking get paid a lot more because they're doing a lot more. They've got AI at their hands, and they've got technology at their hands, and they're doing what 10 people did 20, 30 years ago.
certainly. So maybe some increased productivity, but then, I don't know, lower employment, at least within the sector potentially. Be interesting to see how that sort of phases out. Um, with regards to, I mean, to take it back to the regulation side of the conversation, is there a country that you feel does manage banking uh, legislation and regulation well? I think from my standpoint, I see the statistics and the information coming out that is out in regards to the sluggish growth in the UK economy, within the acknowledgement that financial services form such a large part of what the UK economy is and our exports and what we're able to provide to the global society. Is there a way, is there a country that you think that we could potentially model ourselves after that does certain things well? Or is it a case of some countries do certain things well, some countries do other things badly, and it's just kind of a mix?
I think it's the latter. Yes, I mean, you can look it up yourself, and you'll find what are you looking for in a banking system. If it's financial stability, then you're looking for regulation that strengthens the banks with high capital ratios, high capitalization, capital adequacy, very low fraud, and anti-money laundering laws. So that kind of thing that would destabilize a banking system. These, of course, well, it depends. I mean, they say that Singapore, for instance, has a good banking system for financial stability. Luxembourg has got a banking system that deals, with a huge number of banks, more banks, a larger banking sector than their economy itself, because, of course, their economy is very small. But dealing with lots of international banks. Regulation that might aid lending would be one that I think it's hard to find. At one stage, it was proposed that in some banking systems, in fact, it was in China when they faced the global financial crisis, they suggested that small businesses should be given a lower risk weight. Now, this is a very risky strategy, but the intention was to try to get lending to the small business sector. It didn't work. It didn't work because the banks themselves still refused to make loans, even though they had a lower capital risk weight on lending to small business, simply because the government was so large in China, they'd much rather lend to them. So it's very hard to find one banking system that covers everything. I mean, I'd like to think that the UK is moving closer towards a system where they start to lend again to small businesses. And there has been a recovery in loans to small businesses, but nothing like what it was before.
Yeah. Is that the big question that needs to be answered? I remember having one of the first conversations on this podcast, actually, with Professor Sherry Marcos about this. And her paper was around, why banks don't lend to the real economy. And it talked about a lot of this kind of stuff in the fact that actually banks, particularly post 2008, were just kind of lending to each other as opposed to actually kind of stimulating economic growth through, because to your point, small to medium-sized businesses are the ones that really need that sort of capital financing for various things to increase their productivity. But they are riskier because you don't have the track record, they don't have the economies of scale, and all these sorts of things. And although it sounds as though this example that you gave didn't work in China, I can understand why they've at least tried to take an approach to try and encourage it, because ultimately you do want to encourage loans to small businesses. That's where you're going to get startups. That's where you're going to get growth. That's where you're going to get even just small businesses being able to buy a piece of machinery that increases their productivity. It doesn't have to become a great multinational company, but as long as it's increasing productivity of the average worker or self-employed worker, that's incredibly important. How do you see the market, and how do you think we can encourage greater lending to small businesses whilst also making it an effective model to actually work with?
Well, two things. One is that, of course, fintech platforms are doing some of that already. And if you develop a history and a reputation, you can import that, or rather export that to the banking system. You can say, look, I've been a good customer, and the banks will then take a punt on you. So that's one thing. The other is actually an innovation that some countries have been moving towards, and that is regional development banks. And these are actually banks that are underwritten by public funds, by the government, targeting towards small businesses. They have limited success because they tend to be small themselves. That we're not talking like the big banks of the Lloyds and the Barclays, but they have the success they have is based on local information. There are local regional development banks. They're targeting small businesses, and of course, once you get into the banking system and you develop a reputation, then it's easier to get loans, from the main banking system. These are small tendencies, but I think they're encouraging. I mean, here in Wales, of course, it wasn't long ago we didn't have a development bank. We now have a development bank. One could question their lending policies and all that, but it's there, and their target is to help to develop businesses in Wales. Now, I can imagine that regional banks of that type would be a good idea, because you will actually using local information.
Hmm.
And in a way, it's replacing relationship banking, because what's on the other side, what's been happening is large commercial banks have been moving their decision making towards regional and central headquarters. So they've been removing their relationship managers, they've been closing their branches, uh, and FinTech and regional banks, regional development banks, and challenger banks have been coming in to replace them. It's hard to see yet whether this expansion of the challenges of the development banks and fintech will completely offset the removal of the larger banks. But there's portents in the wind, if you like.
No, no, I think it's interesting. Certainly, having more regional banks, I guess, in that regard, would allow you to have more regional based information. So at least that person to person traditional banking role that you kind of mentioned earlier is a little bit easier if you do that on a regional level, perhaps. But again, maybe there's some problems with scale and all this kind of stuff, and honestly, just setting up these institutions to make sure they can work effectively. Maybe, yeah.
Well, the philosophy of the German Landesbanks has been essentially that, but one of regional and industry based. And there's much closer relationship between those banks and their local industry than in the UK.
Yeah. So is that a case then? Maybe is it more regional, but also more specialized banks? So banks that can, that specifically work with a particular industry. They know the ins and outs of that industry. And so where a traditional bank just maybe doesn't have the infrastructure to have detailed knowledge of a specific industry, like coal mining or whatever it is, I'm sure they do. But when you have a industry specific bank, maybe they are able to reduce risk rates, and because they have more industry specific knowledge in certain instances.
Well, yes, but of course, we've had those in the past. We've had agricultural banks that are specialized in
Sure. Yeah.
agriculture, but competition has forced them to diversify and move into other areas, because putting all your eggs in one basket is very risky.
Sure. Yeah.
Offset that by having local knowledge. But on the other hand, with competition, banks find themselves, their customers wanting more. They've had to move towards more what's called the universal banking model, where they're offering all kinds of banking services and covering all kinds of industries. And that really has been to diversify risks of staying in one place. So, you know, I if you're going to have a regional bank and you're going to have a specialized industry bank, you need to have deep pockets in terms of capital, but also will people investors are willing to take more risks. Now that is very difficult, and therefore that's why banks such as these have government underwriting. The Welsh, the Development Bank in Wales will have an official underwriting system where the public sector will hopefully will be there as a backstop.
I see. And part of the reason, for small businesses trying to get loans so they can, increase and expand their expertise and their businesses is also related to the interest rate. And obviously that comes back to sort of the base rate that's either set by the Bank of England or whatever base rate is, set in whatever country they're in. We've obviously just come out of this period of extremely low interest rates. We've got kind of post 2008, sort of 1-2% interest rates, historically low. And although interest rates are now sort of at 4-5%, it's slightly coming down depending on where you are in the world, there's still a lot of pressure I see to reduce interest rates. Now, obviously, the Bank of England and other central banks are concerned about inflation, and that's why maybe they're not dropping them as quickly as intended. I think my concern, to some degree, is that I'm not actually sure extremely low interest rates are particularly beneficial in all outcomes, and maybe people aren't necessarily considering these things. I spoke with Professor David Miles about this, and overwhelmingly, the record numbers in terms of house price inflation in the UK over the past 30 years is overwhelmingly because of very low interest rates, because of the way people buy housing. And that's led to a situation where, the average house price in the UK was about 3.5 times the average annual salary, maybe in the 90s, but is now up to 8 to 10 times the average annual salary. So it's this incredible negative externality that has maybe come about with also having relatively low interest rates. Can you talk to me a little bit about interest rates and how they affect business? and how relative levels of certain interest rates might be beneficial or even potentially negative on an economy.
Well, I think David Miles is right about the period of low interest rates, because certainly interest rates remain low for too long, and following the global financial crisis, and of course, the central banks and the Bank of England reacted in exactly the same way with the COVID crisis, by having low interest rates and more quantitative easing. Now, the the effect of low interest rates certainly has created huge inequality in asset holders. Those who held assets, of course, seen their capital values rise, and that's contributed to a huge inequality in the economy, and that has its own social problems, particularly the one that you mentioned, that house prices have risen beyond the reach of many young people, and consequently the social tensions that arise from that. Of course, I mean, right now we're going through a period where the bank, I think, the central banks, the Bank of England, has reacted the wrong way to COVID. They reacted in much the same as the global financial crisis, by having quantitative easing and low rates of interest. It's unclear that a supply shock of that nature should have been handled in the same way as a demand shock of the global financial crisis. The global financial crisis was one where, as a result of bank lending suddenly deteriorating, and expectations of the economy deteriorating, demand fell. You know, you needed to boost demand through quantitative easing. Well, that may be the appropriate thing. Some people would argue, yes, that was the right thing to do. But with COVID, that was a supply side shock. And it's unclear what the central bank can do. The problem with central banks is that, partly because of the fact that they're all independent, and that's a good thing, they've created a bureaucracy of themselves. They feel that they can do something. Now, there are sometimes that, organizations have to stop and say, well, we can't do it. Or governments have to stop and say, we can't do anything about this. But we've created a system where we somehow feel that they have to be able to do something, and they have to be seen to be doing something. Quantitative easing is arguably not the right policy for a supply side shock. We pumped in liquidity into the system, creating an overhang of liquidity for those who had it, people who were being paid to stay away from work, asset prices rising for those who had assets. All these things created a very distorted and disjointed system.
Hmm.
Of course, that does not change the fact that right now, we still need to stimulate expectations and return confidence. And interest rates play not just the role of the cost of money, the cost of borrowing, they play the role of reasserting confidence. And right now, with the economy in a sluggish state, with unemployment creeping up, and productivity being low, we need something to stimulate confidence. And interest rates is one of the things that can be there to help us. And it doesn't help us to hear that the government spends huge amounts of money if that money doesn't go into productive capacities. Whereas interest rates do have this ability. Now, of course, one could argue how effective it is, but that's a different argument. I mean, but it's the only one we have in town at the moment. The central bank is only controlling the rate of interest, and they could signal an economy that needs to be stimulated through a rise in through a fall in interest rates.
Sure. Yeah, there's a lot of stuff there in there. I think. I mean, in regards to the COVID stuff, I mean, I was always concerned when they announced that they were going to do the level of quantitative easing that they were going to do back then. Even back then, I think it was something like a quarter of the money supply they're essentially going to sort of replicate in that regard. And it's exactly to your point. When you have a supply shock like that, as opposed to a demand shock, i- if you're going to do that, ultimately people with assets are just going to end up inflated, because ultimately if you give people money, where they spend their money, they spend it in shops and on businesses and say, okay, cool, that's great, you get some stuff, but ultimately it's going to a business, and that business is an asset, and that asset will obviously go up. And ultimately, over the long run, your money will devalue to some degree. Your money isn't going to be worth, and so you get inflation. And so I was always concerned when we were considering this methodology that actually we were trying to subsidize a level of income and a level of ability in the short run, and sort of having a negative impact on the public in the long run, because ultimately inflation is what bites working people and the poorer people the most, right? Because working class and poorer people don't necessarily have as many assets as wealthy people. And even their marginal propensity to consume is much higher. So the items that they are consuming and that they have to consume because their MPC is higher are going up, whereas richer individuals have more assets. Those assets inflate, and they have a lower marginal propensity to consume, so they're spending less money on the stuff that's going up anyway. And so, yeah, I think it's interesting regarding the central bank. I think it's almost an interesting situation where they almost it's a big situation. People are in a lot of stress. There's a lot of pressure, and they almost felt like they had to do something almost, and to some degree. Whereas to your point, maybe the best decision was maybe not to do nothing. I think particularly in those first several months, you had to do something in order to give confidence back into the economy. But whether it had to be to the level that they did it to, perhaps not. With regards to moving forward, in terms of how the UK, but also I guess maybe some other countries as well, particularly in the Western world, manage the banking industry moving forward, how do you see the banking industry changing over time, and what would you say to or recommend for the UK industry or policymakers to try and increase the productivity and growth within the banking sector as a whole?
Well, banks have deregulated to the point where they've mixed in the investment banking, corporate banking, retail banking all together. And of course, the first 1930s crisis, the whole Glass-Steagall Act and the Federal Reserve System, was to actually separate out investment banking from retail and corporate banking. We've tried to do this with the Vickers report, separating out the retail sectors from the retail parts of banking from the other parts, and to some extent that's created banks that are safer, and that's good from the point of view of the depositor. It of course has meant that there have been restrictions on lending. So it could be that in the future banks will navigate themselves closer towards the narrow banking field, where you have safe deposits, and these banks are purely investing in safe assets. What the former governor Mervyn King called boring banking. This will be the boring part of banking, where simply the assets will be government bonds, safe assets, low yield, low rates of return, but safe, and you're protecting the payment system. See, I'm not sure that's going to survive, because what we're seeing also is that central banks are experimenting with digital currency. If this takes off, and I'm not sure if it will, but if it takes off, people don't need to worry about safety. The most safest currency is the central bank digital currency. And of course, what they mean is that you don't actually have currency, you just use your phone or your card. Now, central banks, therefore, then can act as the final stop for the payment system. So where will that leave banks? Of course, banks will still be offering deposits in competition with central bank digital currency, and some people will stay with banks, but it'll be much smaller. But that means that banks will move much more towards the wholesale investment banking side of business. And that will be one that takes risk. And people who put their money in there will know that they won't have the same deposit insurance system as the central bank digital currency or the retail banks, which is the narrow banks where their funds are protected by deposit insurance. Those people who are going into the wholesale banking business will be expecting a higher return, they'll still be expecting the banking services will be able to withdraw their money on demand, but they won't have deposit insurance protecting them if any of those banks fail because a large business that they've lent to have failed. So that's the risk. But it does mean that banks will be taking more risk, largely because they've separated out between the retail side and the wholesale side, or the investment side. So I can see that banks remaining, they may remain in the same organization as the Vickers report anticipated, but they might also separate out. You might have, let's say, GB Bank that looks at purely the retail side, and the GB Bank, its partner, looking at the investment side. And now that would be a good development, because banks will, those ones who are on the investment side, will be less hampered by capital adequacy regulations, because they're taking out investment decisions. If they fail, they fail, and people are taking a risk, much the same as if you put your money into the stock market. Stock prices can go down as well as up. Well, you put in £100 into your investment bank. You may get more than £100 out with your interest. You might get less if they fail. Okay, you put your £100 into a retail bank, you expect to get £100 back.
Indeed. And there is a continuous this continuous movement at the moment towards ESG requirements. A lot of large listed companies now have to do a lot more reporting on things like ESG requirements, even the things like climate change as well. I was talking to someone from Network Rail the other day, and one of the big risks that I hadn't necessarily anticipated with the organization that they were addressing and they'd outlined in their annual report was in regards to the climate. There's been a lot more storms and stuff in the UK, and that's causing certain damages to certain lines and infrastructure that's a little bit older. And so one of the big focuses was making sure that infrastructure was updated, and obviously that requires financing actually from banks and other institutions. How do you see the role of ESG and just climate and general sustainability affecting the banking industry over the next several years? I mean, you've also got things like emissions trading schemes, which undoubtedly they'll be involved in as well. So how do you see the role of that component factoring into the banking industry?
Well, okay, I two things. First of all, I mean, there's a literature out there, a research literature that suggests that firms that have ESG credentials are signaling that they are good quality firms and that they are low risk. And there's evidence that they've commanded a lower rate of interest. So there's lower spreads on their cost of borrowing. Whether that's sustainable, I don't know, because the jury's still out. I mean, but that certainly there's evidence that firms that have ESG credentials are treated by the banks as low risk. Now, I have to take that as the banks know what they're doing, and they recognize what's good quality or not. On the other hand, there's also central bank and regulatory authorities forcing banks to take positions on ESG lending. I think that's a big mistake, because I think banks have to learn themselves what's good risk and bad risk, and it may be that they would have done this anyway. But if they're being told to do it, there's the possibility that they'll be forced into making decisions that are suboptimal from the point of view of a banking business. They're simply doing this to meet regulatory requirements, and of course, usually well-intentioned policies of these kind of nature have unintended consequences. Green technology is not without risk. I mean, anyone in science will tell you that some of them are good quality, and some of them, there's an awful lot of stuff that comes out of China, where banks have have lent to, that have actually failed. We don't hear about them because those are failures. We only hear about the ones that are successes. All right, so banks have taken a hit on many of these things, and they've been pushed really by regulation and government. So it's not a good idea to be too prescriptive on these. Banks themselves will work out through their customers' preferences. It was a bit like what the cooperative bank, had customers that insisted that they should lend on to ethical industries. Well, it's, if they're prepared to to have that rate of return that's commensurate with that, well, then that's what their depositors and their shareholders want. Islamic banks have rules about ethical lending to ethical industries. Well, that's their business. Let them do. You don't need to have someone tell them to do this. And so I think that it's probably a mistake to be too prescriptive. But the jury's certainly out on ESG credentials. Banks are treating some of these firms as good risks. Well, let's wait and see. Let's assume they know what they're doing.
Indeed. We'll have to just wait and find out. Ken, thank you very much for joining me. I really appreciate you sitting down and talking with me. Is there anything you'd like to point the listeners to, some of your materials and some of your textbooks and stuff?
Yes, I think for those of us who've listened to this, it'll be interesting to come back in 20 years' time to see, what we're predicting about banks, because banks will exist, but they will exist in a different form. I mean, certainly the bricks and mortar banks that we are used to will by then disappear. I think that'd be rather sad, because for some of us, we actually quite like those old buildings. There's a bank just around the corner to where I live. That's was a National Westminster Bank. It was part of the National and Provincial Bank of England. It was set up in 1835. It's got in big letters there. It'll probably be turned into a cafe or something like that. But
or Weatherspoons, yeah.
or Weatherspoons. But yes, but it's a shame, because some of these buildings are wonderful, and it was a great a place for social interaction, just to go in and have a chat with somebody. But banks will be different, but they will still be there.
Ken, thank you very much for your time. I really appreciate it.
Okay, welcome.